2 years ago, Palantir was trading under $10. Almost nobody cared. Today, it's up more than 1,000%, and suddenly everyone claims they saw it coming. They didn't. What they missed wasn't luck. It was a pattern, and that same pattern is showing up right now in a handful of misunderstood stocks still trading under $10. 2 years ago, almost nobody cared about Palantir. It was trading under $10, buried in the market, written off as another overhyped tech company that had already missed its moment. Today, it's up more than 1,000%, and suddenly everyone is asking the same lazy question: what's the next Palantir? The irony is painful, because Palantir didn't suddenly become a great company. It had already been operating for more than 2 decades. It went public years earlier. Its technology, contracts, and positioning existed long before the stock exploded. What changed wasn't the company. What changed was visibility. The launch of generative artificial intelligence flipped a switch in the market's brain, and investors rushed to reprice anything connected to data, defense, and AI infrastructure. Palantir happened to be standing there when the spotlight turned on. That's the part most people miss. The next major winner is almost never brand new. It's usually misunderstood, ignored, or stuck in a temporary narrative that the market hasn't revisited yet. The opportunity lives in that gap. That's where this entire analysis begins. The companies discussed here are not hype plays. They are businesses with real operations, real revenue, and in many cases real profitability, trading at prices that suggest the market either doesn't understand them or hasn't bothered to look closely enough. Some are boring on the surface. Some operate behind the scenes. Some exist in sectors most retail investors barely follow. That's exactly why they matter. One example is a company quietly powering the digital screens people interact with every day without thinking twice. Stadium video walls, fast food menu boards, corporate lobbies, retail displays. The hardware is only part of the story. The real value sits in the software layer that allows global brands to update content instantly without IT intervention. This company doesn't just sell screens. It sells an integrated system. Hardware, cloud-based content management, and creative services bundled into one package. When revenue dipped recently, it wasn't because demand disappeared. Large contracts were pushed forward, margins held steady at levels that prove pricing power still exists. More importantly, management used cash flow to reduce debt instead of chasing reckless expansion. That decision matters. Analysts see massive upside not because the business is perfect, but because it's stabilizing while the market still treats it like it's broken. Another misunderstood name sits in clean energy, but not where most people expect. Instead of manufacturing solar panels, this company builds the mechanical systems that allow those panels to track the sun throughout the day. That single function increases energy output dramatically compared to fixed installations. Even more important, its supply chain is largely domestic, which qualifies projects for government incentives and avoids international delays. Revenue surged as those incentives kicked in. Profitability followed. Margins expanded in ways that simply weren't possible at smaller scale. The stock recently moved faster than analysts expected, forcing them to play catch-up. That dynamic is dangerous for short sellers and extremely profitable for early investors. When a company consistently beats expectations, narratives break. Gold has been another area where surface-level analysis hides deeper opportunity. Most people think of gold as dead money. It sits there. It doesn't pay income. It's insurance, not a growth asset. But mining assets are a different story, especially when insiders are buying aggressively. One junior miner operating in a premier U.S. jurisdiction holds millions of ounces of measured and indicated gold while trading at a fraction of peer valuations on a per-ounce basis. The math doesn't require imagination. It requires patience. When insiders put millions of their own money on the line, that's not marketing. That's conviction. Infrastructure tells a similar story in emerging markets. A tower operator managing thousands of cell sites across Africa and the Middle East benefits from a simple but powerful model: multiple tenants leasing the same physical asset. Revenue scales without proportional cost increases. Inflation-linked contracts protect cash flow. Margins expand slowly but steadily. Debt levels improve quietly. These businesses don't explode overnight, but they compound while no one is paying attention. When growth markets mature, infrastructure owners tend to be re-rated sharply. Healthcare adds another layer of asymmetry. A small payments company operating prepaid card systems for plasma donors and pharmaceutical assistance programs sits in a niche most investors don't even know exists. As healthcare costs rise and reform pushes affordability programs forward, demand for these services accelerates. Revenue growth north of 40% is not theoretical. It's happening. Margins are expanding. The company carries no debt. That combination is rare, especially at a small scale. Businesses like this don't need hype. They just need time. Mental health services provide another example of narrative shift. A digital therapy platform originally built for direct-to-consumer subscriptions struggled for years. Then it pivoted. Instead of chasing individuals, it focused on employers, insurers, and government programs. Revenue became steadier. Losses narrowed. Cash reserves bought time. The business didn't reinvent itself. It simply chose a model that matched how institutions actually buy care. That shift matters far more than flashy user numbers. Resource extraction rounds out the picture. High-grade iron ore producers with access to premium pricing benefit from global pressure to reduce emissions in steelmaking. Cleaner inputs command higher margins. Shipping disruptions temporarily masked performance, but underlying demand didn't change. Balance sheets remained strong. Debt stayed manageable. These companies don't trade like tech, but when cycles turn, they move with force. Biotechnology is where speculation reaches its peak and where discipline matters most. A clinical stage company pushing a novel therapy through late-stage trials carries obvious risk. Cash burn, regulatory hurdles, and binary outcomes define the space. But when cash reserves are strong and debt is non-existent, survival becomes likely. Success becomes optionality. Analysts projecting absurd upside are not guarantees. They're reflections of asymmetric payoff structures. Most will fail. A few will redefine portfolios. Energy producers focused on free cash flow rather than growth at all costs offer yet another angle. Steady dividends, disciplined spending, and geographic diversification create resilience. When commodity prices cooperate, profits surge. When they don't, balance sheets protect shareholders. These companies aren't exciting until they suddenly are. Finally, semiconductors bring the conversation full circle. A domestically owned specialty foundry serving defense, aerospace, and industrial clients occupies a strategic niche at a time when supply chain security is no longer optional. Revenue fluctuations tied to project timing don't erase long-term relevance. Capacity expansion tied to government contracts changes the valuation conversation entirely. Across all of these examples, the common thread is simple. None of these companies are obvious. None are being screamed about by mainstream financial media. Each operates in a space where a catalyst, whether regulatory, technological, or macroeconomic, could force the market to reassess value rapidly. That's how Palantir happened. Not overnight, not randomly. It happened because the world caught up. The real question isn't which stock will be the next Palantir. The real question is whether investors are willing to do the uncomfortable work of owning something before it's popular, before it's understood, and before the story is easy to tell at a dinner table. Because by the time it is, the opportunity is already gone. The uncomfortable truth most investors refuse to accept is that finding the next breakout stock is less about brilliance and more about temperament. The market does not reward impatience. It rewards the ability to sit with uncertainty while everyone else looks away. Every company that later becomes obvious spends years in a phase where holding it feels stupid. That phase is where the edge lives. When people look at a stock that's under $10, their brains immediately short-circuit. They assume cheap means weak, broken, or fraudulent. Sometimes that's true. Most sub-$10 stocks deserve to be there. But every once in a while, price has nothing to do with quality. It has everything to do with neglect, timing, or narrative mismatch. That's where asymmetric opportunities form. Take companies that operate behind the scenes. Infrastructure, compliance software, payment rails, logistics platforms. These businesses don't trend on social media. They don't excite retail traders. But they embed themselves into systems that are painful to replace. When revenue dips temporarily, the market panics. When margins hold and debt improves quietly, no one notices. That gap between perception and reality is exploitable. This is where analysts often get it wrong. Analysts are reactive by design. They update forecasts after price moves, not before. When a stock jumps 20 or 30% ahead of earnings revisions, that's not luck. That's the market discovering something before the spreadsheets do. And when analysts scramble to adjust targets upward, it's a signal that consensus was lazy. The solar infrastructure company mentioned earlier is a perfect example. Most investors think solar equals panel manufacturers, which are brutally competitive and margin thin. Trackers don't get headlines, but they directly improve project economics. That makes them sticky. When government incentives align with domestic sourcing, the competitive moat deepens overnight. The market didn't misprice this business because it was bad. It mispriced it because it was boring. Gold miners expose another behavioral flaw. Investors love the idea of gold, but hate the execution. Mining is capital-intensive, politically sensitive, and operationally complex. So when a junior miner trades at a massive discount to peers despite holding proven reserves in a stable jurisdiction, people assume something must be wrong. Sometimes nothing is wrong. Sometimes the market just hasn't bothered to re-rate it yet. Insider buying doesn't guarantee success, but it dramatically reduces the probability of deception. Executives don't deploy personal capital casually. They do it when they believe time is on their side. Emerging market infrastructure challenges another bias: geographic fear. Investors hear Africa or Middle East and immediately price in instability. What they ignore is demand growth, population expansion, and mobile adoption curves that dwarf developed markets. A company leasing cell tower space doesn't care which carrier wins market share. It wins regardless. Inflation-linked contracts and multi-tenant economics turn volatility into a feature, not a bug. These businesses rarely collapse. They compound quietly until suddenly institutions wake up. Healthcare affordability platforms illustrate how regulation creates opportunity. Whenever governments attempt to lower costs, complexity increases. Complexity creates demand for intermediaries. A prepaid card system that helps patients manage copays isn't glamorous, but it solves a real problem. When revenue grows triple digits in a segment most investors didn't know existed, that's not a fluke. That's a market forming in real time. Digital mental health companies show how strategy matters more than product. Direct-to-consumer models are expensive, churn-heavy, and emotionally volatile. Enterprise contracts are boring but durable. When a company pivots successfully, the financial statements change long before the stock narrative does. Early investors get paid for noticing first. Resources and energy companies teach a different lesson. Cyclicality punishes the impatient. Iron ore producers, oil and gas firms, and specialty miners swing with macro forces outside management's control. But balance sheet discipline determines survival. Companies that focus on free cash flow rather than growth fantasies emerge stronger after downturns. When pricing improves, profits don't just recover, they explode. That's when re-rating happens. Biotech is where discipline is most critical. Analysts throwing out 500% upside numbers are not predicting outcomes. They're modeling possibilities. Most clinical stage companies fail. That's reality. But when cash is sufficient and debt is absent, optionality increases. Investors aren't buying certainty, they're buying convexity. One success can outweigh multiple failures. That doesn't make biotech safe, it makes it strategic. Semiconductor manufacturing brings geopolitics into the equation. Domestic capacity isn't optional anymore. Governments don't negotiate with fabs the way markets do. They fund them. Contracts tied to national security don't vanish during recessions. Revenue volatility tied to project timing is noise. Strategic relevance is signal. What ties all of this together is not sector, size, or geography. It's misunderstanding. Each company exists in a space where the market narrative is incomplete. Either the business is lumped into the wrong category, judged by outdated assumptions, or ignored because it doesn't fit a clean story. Palantir lived in that gap for years. People dismissed it as government-only, opaque, unscalable. Then artificial intelligence reframed the entire conversation around data infrastructure. Suddenly, what looked niche looked essential. Nothing fundamental changed overnight. Perception did. That's the real takeaway. The next breakout isn't hiding because it's invisible. It's hiding because people don't know how to look at it yet. If you're waiting for certainty, you're already too late. If you're chasing confirmation, you're paying a premium. The edge belongs to those willing to hold something while it's still uncomfortable to defend. And here's the part most people won't like. You don't need 10 of these ideas. You need 1 or 2. Over-diversification is often just fear disguised as prudence. The market doesn't reward collection. It rewards conviction backed by understanding. So the real work isn't finding the next Palantir. It's developing the discipline to recognize quality before the crowd agrees and the patience to hold while everyone else is still asking the wrong questions. That's where outsized returns are born. Palantir's rise wasn't random. It was the result of a long-established business colliding with a sudden catalyst that forced the market to reprice its value. Using that framework, the script walks through a curated list of under $10 companies across technology, energy, healthcare, infrastructure, and commodities that are currently misunderstood, underfollowed, or mispriced. Each company is evaluated not just on hype, but on real fundamentals. Revenue trends, margin expansion, balance sheet strength, insider behavior, and upcoming catalysts that could force analysts and institutions to catch up. Some offer steady cash flow and infrastructure-style stability. Others hinge on asymmetric upside through regulatory approvals or macro tailwinds. The closing thesis narrows the list down to the few that best combine financial discipline, real demand, and clear visibility events, reinforcing the central idea that the next Palantir is rarely obvious, rarely glamorous, and almost always hiding in plain sight before the crowd shows up.